Welcome to Standard & Poor's January Loan Market Overview Clip. I'm Steve Miller, a member of S&P's Leveraged Commentary and Data team. This month we'll focus on recapping the major events of the year just passed before winding up with a 2011 outlook. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. Here is our standard disclaimer for your review. Now to the topic at hand. The loan market finished strong in December. With technical conditions firm, the market was able to absorb a flurry of new issue paper even as secondary prices ran higher. The S&P LSTA index, for instance, posted a 1.2% return in December. For all of 2010, loan returns were 10.2%, building on 2009 record 52% gain. Despite 2008's black swan decline of 29%, a dollar invested in loans at the end of 2007 would now be worth about $1.17. Helped along by robust demand, new issue activity in the fourth quarter jumped to a three-year high of $70 billion. Volume for all of 2010 was up 204% to $233 billion. It wasn't just technicals driving the market higher at year-end. The loan market's credit picture continued to improve as well. The loan default rate dropped to a 2.5-year low as upgrades exceeded downgrades by a ratio of 1.6 to 1. For the leveraged loan market, the big surprise of 2010 was the absence of any meaningful surprises. Aside from a mild jolt delivered by Europe's sovereign debt troubles in May and June, the past 12 months brought a welcome return to normalcy after 4 bipolar years. With conditions more stable, issuers and private equity firms ramped up refinancing, dividend, and M&A activity. Looking ahead, players generally expect a 25% or so increase, with the emphasis shifting from maturity extension exercises and dividends to M&A. In early January, the market continued to gain ground. LCD's flow name composite, depicted here, is a price measure of the 15 largest, most liquid institutional loans. During the first week of January, the composite pushed up about 1% to a three-year high of 97.5. The increase reflected the ongoing imbalance between demand and supply. The rally of 2010 had three primary drivers. First, demand was bolstered by a jump in the loan repayment rate to 27% from 15% in 2009. As well, retail investors poured a record $16 billion into loan mutual funds in 2010, according to Lipper FMI. Lastly, the ranks of bank and non-bank loan accounts expanded in 2010 after 2 years of decline. As long as rates are expected to rise and default rates remain low, managers think the loan asset class will continue to capture the imagination of both retail and institutional investors. The loan default rate fell to a 2.5-year low of 1.9% in 2010 from 9.6% in 2009. What drove default rates off a cliff last year were three primary factors. First, the economic recovery, combined with aggressive cost-cutting, produced strong cash flow growth. Second, the terrible default spike of 2009 pushed many of the weaker players into bankruptcy, leaving a hardier field of survivors. And finally, better liquidity allowed companies to fix or at least patch their balance sheet with bond takeouts and amend to extend exercises. Most players expect default rates, therefore, to stay low in 2011 at between 1% and 3%. As we do at each quarter end, LCD gathered perspective about the prospects for the loan market from a wide range of market players. More so than usual, the message from these wise men and women was uniform. 2011 ought to be a good year that brings to mind such Goldilocks periods as 2003 through 2005, and for those of us around for a while, the mid-90s. Default rates should stay low, volume should trend higher with the mix shifting towards M&A, prices should remain stable, and inflows should continue apace. Yes, it all looks pretty good so long as the economy proves resilient. Europe avoids a major sovereign default, ditto the U.S. municipalities, oil prices remain under control, and there are no nasty geopolitical events or market meltdowns. So really, what could go wrong? Well, that brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video. As mentioned, you can also download this presentation at slideshare.net.